Are we heading towards a recession? A lot of fund managers and professional investors seem to think so. And according to CBS News, 60% of Americans think a recession is just right around the corner. But to avoid thinking like a lemming, I also took a look at what economists think is going to happen. A whopping 28% of economists surveyed by the Wall Street Journal are predicting that the US economy will fall into a recession sometime in the next 12 months. And this is up from just 13% a year ago. So twice as many economists think we're headed toward a recession as did the same time last year. And while the economists aren't quite as pessimistic as the rest of America, it still means that there is a risk of recession this year. In this video, I'm going to cover the absolute worst thing you can do in a recession and also walk through some of the things you can do to prepare yourself so that you come out ahead. Don't forget to like the video and subscribe to my channel so you don't miss any more future content on finance and real estate and business. Okay, well, with all that being said, you're sitting there probably thinking, okay, well, you haven't even explained what a recession is. According to Forbes, the definition of what constitutes a US recession is somewhat flexible, but 2 successive quarters of negative economic growth is the standard definition. The Great Recession, for example, lasted for about 2 years, and it was one of the largest and deepest recessions in history. The COVID-19 recession was a little different. It actually only lasted 2 months, but economists still considered it a true recession. And while we have had 1 quarter of economic decline, we're still waiting on a second quarter to see if we could fall into that categorization of an official recession. Now, a natural question to ask is, why are we heading towards a potential recession? And I think a lot of it has to do with the massive inflation that we've seen over the last couple of months. Due to the Fed's monetary policy program of quantitative easing, trying to get us out of the recession from 2020 made them print a whole ton of money, basically. And one way that I like to think of inflation, imagine it like an equation. On one side, you have a basket of goods that is largely fixed, and then you have a pile of money. And when you add a ton of money into this pile, and you don't increase the size of the basket of goods, it means you have a lot more dollars competing for the same exact basket of goods, which means the price of each individual thing within that basket increases. So to combat this inflation, the Fed actually has a couple of tools, and they've turned into what they call quantitative tightening. And one of the main tools that you all have probably seen has been raising the interest rates. You've probably seen your mortgage rates or bank loans go from about 3% earlier this year to now well over 5%, which has been the greatest increase we've ever seen in a short period of time. And unfortunately, as we've seen from many historical recessions in the past, the Fed doesn't always nail the landing here. There's a fine balance to strike between raising interest rates and letting the economy cool down without crashing down and burning and entering into a recession. And so unfortunately, this means many times in the past, when the Fed has raised interest rates, that has slowly caused a recession in the economy. And this article from Yahoo Finance illustrates this. For those concerned that the Federal Reserve hiking interest rates will tip the economy into a recession sooner rather than later, try this data set on for size. It takes around 3 years from the first Fed hike to enter a recession, according to 70 years of data on rate increasing cycles crunched by Deutsche Bank. The quickest recession could be traced back to July 1981. Under then Chairman Paul Volcker, the Fed began increasing rates in August 1980 to cool double-digit percentage consumer price inflation. Sounds familiar, just like it is today? About 11 months later, the economy was in a recession, according to Deutsche Bank's analysis. The longest it took to enter a recession after the first rate hike was 84 months. So now that we've established a recession is very possible in the coming months, let's talk about what you should do, and maybe more importantly, what you should definitely not do in case of a recession. All right, guys, as we think of what we should do during a potential recession, I want to take a look at these 3 buckets. So our personal finance situation, our investment strategy, and your job or your employment situation. So starting off with our savings safety net. It's a really good rule of thumb and best practice to have between 3 and 6 months of expenses saved up in the case that you lose your job or don't have access to any money, that you can still support yourself for that 3 to 6 month time period. So that would be number 1 that I would suggest you do. Next, let's take a look at existing debt. Rank and prioritize your debt based on how much it's charging you, so the interest rate. Typically, the most expensive debt you have is going to be credit card debt and consumer debt. So definitely want to take a look at those. If you're paying 19, 20, 21% on credit card debt, absolutely do your best to get rid of those because that's extremely painful. Other debt like mortgages or car loans that have reasonable interest rates, anywhere maybe 3 to 5, maybe 6%, isn't going to be as worrisome as consumer debt is. And next we have new debt. So given the environment right now, I'd be very hesitant to taking on any sort of new debt, especially if it's consumer related. I mean, make sure you have your spending under control. Don't be spending a ton of money on clothes or purses or consumer electronics, things that don't really matter. But if you are in a position where you need to buy a house or you need a car, then that might make a lot more sense. Where I would really caution you is if you're thinking about getting a second home or a second or third car that isn't really necessary, really just take the time to think if this is right for your personal financial situation right now. And last is cash flow. Maybe I should have started with this one because it's honestly the foundation of all of this, is making sure you're cash flow positive each month. So what that means is your income is greater than your expenses, which means you're building up a savings every month. Definitely don't want to be in a situation, especially right now, where you're spending more than you're making. Okay, so now let's touch on what your investment strategy should look like. So number one, and probably the most important thing, don't sell everything. It's very important not to lock in your losses and to sell at the bottom of the trough, because then you're going to miss out on a lot of the upside when the market does eventually rebound. First of all, we just don't know when we're going to hit the bottom of the market. We don't know if we've already hit it, or if we're 6 months or 8 months or 10 months away from hitting it. We have no idea how far it could go down or if it's going to start going back up immediately. And remember, professional investors have massive teams of people and spend millions and millions of dollars trying to answer this exact question. And they have complex algorithms and models to do this for them, and they're still not able to get it right. So the likelihood that you or I will be able to do it just with our little brains inside of our head is probably pretty unlikely. So I wanted to show you guys some of the data that proves why selling right now would be a really bad idea. And this is from AAIILA.org. Despite all the educational efforts and prudent processes provided by financial advisors, investors may be tempted to take control in a way that is likely to be detrimental to them by retreating or selling out of the market after a significant drawdown, locking in their losses and looking to re-enter when the market feels safer. So this compares the return experience of a $10,000 investment in the S&P 500 over the past 20 years. So if you'd started 20 years ago with $10,000 and you never pull it out of the market, this is this first bar right here, you would have had a 6% return and your money, a 6% annual return, and your money would be now $32,000. Now, if you'd missed 10 of the best days, that return would have been cut in third, and you'd only have $16,000. And then it keeps getting worse and worse and worse. So basically, missing the best days of the market is really detrimental to your overall returns. And how close are the best and worst days? Vary. As of year-end 2019, 6 of the best days occurred within 2 weeks of the worst days, but are often spread much closer than that. You can see here from this extreme example, in March 2020, the worst day was Thursday, March 12th, and then the best day was the following day on the 13th. It was the 4th best day in 20 years. And then following that, we had another really bad day. August 2015, something very similar, worst day, 2 days later, best day. December 2018, same thing. So again, it's really important not to think that you can outsmart the market and that you're going to be able to sell when it's low and buy when it's high, because you're probably going to miss out. So assuming you're not going to sell out of your entire portfolio and you're going to continue investing in the market is what I would recommend, and do that with dollar cost averaging. So that just means investing the similar amounts of money periodically, no matter if the market is up or down or what your perception is of it. And that's generally the best approach. So one of the best places to invest in a recession is what's called defensive stocks or defensive sectors. And if you just think about it holistically, these are the sectors that recessions are going to be less impactful on. So things like consumer staples, right? People always have to eat, they have to drink, all those sorts of things are going to be very consistent. So you have consumer staples, you have utilities, you have the energy sector, and you have healthcare are generally safe bets during a recession because they tend not to fluctuate that much. And then finally, another important piece of advice, be very careful rebalancing your portfolio. It goes back to this point A right here, is if you're selling things, you're locking in losses. So if you're lowering the overall risk of your entire portfolio, you're generally going to lower the return potential of that portfolio. So when the market does rebound again, your gains aren't going to be as high as it would have been if you'd stuck with your original plan. Again, this is something that's very personal. So if you want to lower the overall risk of your portfolio, I would do it as I'm continuing to invest with dollar cost averaging instead of rebalancing my existing portfolio. So the last thing we want to consider today is your job or your employment. So if you're considering jumping on the bandwagon of the Great Resignation, like so many other people have done this past year or two, it might be a time to slow down a little bit and just really be thoughtful about your next career move. Many companies right now, as you've probably heard, are starting to slow down hiring or stopping altogether. You've probably heard about Facebook or Meta, along with a number of other companies, especially tech-focused, that are slowing down or stopping hiring altogether. That being said, right now might actually be a great time for you to move, depending on your personal situation. Just remember to focus on finding companies that might fare better in a recession, so companies that are more recession-proof than others. And the last thing we have here is education. Probably the best thing that you can do in the event of an economic downturn or a recession is to reinvest in yourself. Go back and get some additional education, finish that degree that you haven't finished, or start one, but make sure you really do your due diligence on the degree to make sure that's going to be a valuable investment and then it's going to pay off with a higher salary in the future. All right, guys, I really hope you found this video helpful. Please don't forget to smash the like button and click that little subscribe button down below so you don't miss any more future real estate, business, or finance content. And I will see you guys in the next one.